So everybody will be able to join now, and I'm going to, great.
All right, welcome everybody to, I want to say this is week 10 of our TEI Spirit series. Don't count my word for it though. I didn't have a chance to actually check before this. But today we have the pleasure of having Ami Ziff, who is our Director of National Retail, on with us. He has been working very diligently along with his team over the last 3 to 4 months for obvious reasons, which we're gonna get in today. But I also wanted to allow him the opportunity to spot himself in terms of his tenure at the company and his background and his expertise. So that will Jack here has joined me today, who I think this is the first time that you've actually hosted, first or second time that you've hosted one of these Spirit series. So we're bringing him into the mix. Jack is one of our senior associates on the equity team. For those of you that may not know him, say hi, Jack. There you go.
Hey, Alex.
All right. So, I'm going to, like I did the week before, I'm going to hand this off to Jack for the discussion. Just a reminder for people, I know retail is a good topic, obviously, today. If you have any questions or comments, please enter them into the chat or the question box at the bottom of your screen. And of course, you can always reach out to myself, Jack, or Ami. Afterwards, we'll provide our contact information at the end. So you can call or email us and back with questions. We do have a hard stop today at 1:30, so just we'll keep that in mind, and we'll try to get to everyone's questions if we can. And if not, it's not like we're ignoring you. We're just we have a hard stop. So with that said, I'm going to log off and disappear, and enjoy your time together. All right. Bye.
Thank you, Alex. Thanks for the introduction. Thanks, everybody, for joining us this afternoon. I know we're going to have a pretty interesting conversation. A lot of attendees here interested to hear what Ami has to say. So a quick introduction for Ami, for myself. I've been with Time Equities now for 4 years, serving in the equity department alongside Alex and David Becker. And we are honored today to have Ami Ziff, the Director of National Retail for Time Equities, here with us. To kind of give us his insight into the market and his kind of rise to stardom within TEI. So Ami is in his 9th year with TEI and is responsible for all retail acquisitions, dispositions, asset management, and then the leasing of our 9 million square foot portfolio of, correct me if I'm wrong here, but my numbers show we have 122 properties across 25 U.S. states. So Ami, a little background, he received his Bachelor of Arts degree from the College of Charleston. He's a licensed real estate broker in New York and South Carolina and is an active member of ICSC, currently serving as a National Leadership Board member and formerly serving as Eastern Division Chair for ICSC's Next Generation. In 2012, Ami was recognized as one of New York's Commercial Observer's 30 Under 30, as well as the Commercial Observer's 20 to Watch in 2012. And then in 2015, Ami was one of 4 candidates nominated for the New York Commercial Observer's Rising Star Power Award. So Ami, that's quite a lot. I'm sure all of that is for a reason, and that's why we're having you. So thanks again. I'll just start it off with a couple of questions about you. Basically, I know you joined Time Equities 9 or 10 years ago at this point. What really was your background prior to joining TEI? And when you did join, what capacity were you working with us in at that time?
Sure. So first of all, thanks for having me. It's nice to be here. And you got almost everything right on the introduction, except for this is my 13th year with TEI. So I have been here for 9 years, but that was a couple of years ago. And it's been quite a ride building our retail program. So before I came to Time Equities, I had one job in between out of college, working at a real estate investment bank. And it was doing debt and equity placement and retail investment sales. And it just so happened I was low man on the totem pole, and they needed some help with selling and raising equity for retail properties. So I found myself working in retail. And prior to that, I worked for a couple different firms while in college at the College of Charleston. And it just so happened that their need for, at the time, for whatever reason, was leasing and helping to sell shopping centers. So, retail found me. I didn't find retail, for better or for worse. And I've been eating, sleeping, and breathing it ever since.
That's awesome. So that was going to be my next question. You kind of answered in why retail, but I guess, have you ever done any other acquisitions other than retail, or this has been your prime specialty, at least since joining Time Equities?
Yeah, at Time Equities, I've worked with a lot of different product types, and over the 13 years, I just sort of gravitated more towards the retail, and found myself really enjoying the synergy of having the retail relationships and building those, and so I sort of stuck to the retail, and that's really predominantly what I focus on day to day.
Got it. So I know, we obviously had some retail in the Time Equities portfolio prior to you joining, but since then, having it as your specialty, we really have started to acquire more and more retail assets over the past 10 to 13 years or so. What was Time Equities exposure to retail like prior to you joining, and what was the growth, what was the expansion plan like when you joined?
Good question. I started thinking about this yesterday when we spoke, and it was a good exercise just to look up some numbers. By my count, we've got about 85 retail properties out of town, out of New York City, and 37 in New York City. So when I joined, we owned about 30 out of town retail properties, and we're now up to 85. So that may seem like a lot of growth, which it is, but what's more interesting is the 30 retail properties that were out of town when I joined totaled 1.4 million square feet. And today, our retail portfolio totals 9 million, a little over 9 million square feet. It's about 9.1 million square feet. So that's a tremendous amount of growth in tenants and the actual spaces and relationships that we manage. So I hope that answers the question. By growing from 1 million to 9 million square feet, it really put us on the map with building a retail brand, which allowed us to build and strengthen our retailer relationships, and help us cross-sell our vacancies, retain tenants, and really just connect a lot of dots. So for instance, when we're buying a shopping center, we're often speaking to every one of the retailers, most of which we have an existing relationship with, and asking them, how are the stores performing? Do you plan to stay or leave? How's your health, and what are your views on the center? And that's been tremendously helpful and valuable.
Sure. Well, thank you. Before we keep going, Ami, I got a note from somebody that it's a little difficult to hear you. So anything you can do to speak a little bit more into the microphone. Sorry about that. I just saw that, everybody. So of that mix, kind of right now, just to give everybody a little bit of a clearer picture of what our portfolio looks like right now, because I know we own so many different types of retail, from New York City condo retail to shopping centers, outlet centers. What is the breakdown in the certain types of retail when you take into account closed shopping centers, open air, strip centers, so on and so forth?
Yeah, so another good question. Today we own, out of the 122 retail, there's only one outlet center, although we like that vertical and the value proposition, the discount value proposition that the outlet center offers. We've got 8 enclosed malls, and the rest are open air retail, predominantly made up of discount or value retail, which, as you know, has outperformed the recession in 2008, and we believe will outperform in this economic environment. So we do have a component of grocery anchored centers, power centers, but the vast majority of these are open air centers that have some sort of a discount or value proposition. Most of the retailers are value retailers.
Got it. Well, thank you for that. So going a little bit more into detail on why exactly Time Equities has been buying retail over the past few years. For those of you who are unaware, Time Equities really is a discount value add current income buyer. What was it about retail? What was our underwriting strategy going into this? Because I know so much of our history lends itself to our current investment philosophy, taking into account downside protection in times such as these. So basically, what was our retail underwriting strategy? What were the going in cap rates we were looking in prior to the current situation right now?
So that's a good question. Generally speaking, we're trying to minimize risk when we're looking at these retail properties. And we do that in a lot of different ways. Some ways you can do, some of the ways you can apply to an office building, for instance, or an industrial building, and a lot of the ways you can't. And that's why retail is unique. So there are brands that are leasing space in each of these centers. And by having a relationship or an edge with these brands, it affords you the opportunity to get more information and know who's doing well and who's going to stay. And that allows you to assess the durability of that income stream, that NOI, more so than, you know, a bunch of law offices without any way to know if they're happy there or if they, you know, need more space or less space. So it's just a different way of underwriting. But if you have those relationships, which we have been able to generate and maintain and build and grow and nurture, then it allows you to have this edge. That's sort of the first component. In terms of, you know, why retail and what we bought, you know, Francis's mantra, as I'm sure a lot of, if any investors are on the phone, they've heard this, is make hay while the sun is shining and carry a big umbrella. And, you know, the retail properties that we buy, we try to buy them at a low price, high cap rate, to account for a lot of the risks that we can see and all the risks that we cannot see. You know, sitting in our chair, you know, during the acquisition, underwriting the property. And we know that there's going to be a lot of things that we cannot see. So we try to stress the deals in a lot of different ways and think about them from a lot of different perspectives and apply all the information we have from speaking with the retailers as to who wants to be there, who doesn't want to be there, who's doing well, who's not doing well, who might stay, who might go, and who might need a rent reduction. And then we try to apply different stresses of different scenarios that might happen. And what we believe is that we've been able to produce returns that are outsized, even after considering, you know, many different overly conservative scenarios for what could go wrong with the property. And then we balance that with the upside potential, you know, if the property's 30% leased versus 100% leased, and we try to figure out what an appropriate rate of return is.
Got it. So, of course, we have always underwritten to a worst case scenario, but I don't think anybody would have ever imagined a scenario kind of like the one that we've been in over the past few months with, in some states, people not legally allowed to be open as retailers. So can you tell us a little bit about what's been going on with our, you know, mom and pop and national credit retailers since COVID has hit, and what your team has been doing to negotiate with those tenants who are in distress?
Sure. So as you can imagine, when there's blood in the water, anyone who is an opportunist often seeks to exploit those that are weak. And so we've fielded quite a few rent relief requests. As you can imagine, some are warranted, some are not warranted. And the trick is going through all the detail, reading every single person's lease, going through their historical sales. Are they an essential retailer or a non-essential retailer? Was there an order by the governor to close their business or not? And trying to really understand the facts and parse out what's real versus what's not. And then trying to address the need if it's warranted. You know, so for instance, if you had a grocery retailer, which we didn't have happen in our portfolio, but we did have essential retailers in our portfolio come to us looking for rent relief, who were open, mandated to be open, and had huge swells in their sales. And those fall on deaf ears, those requests, versus, let's say, a local restaurateur who was ordered to be closed in a state for 3 months, and they either had zero or next to zero sales. Those are two very, very different scenarios, and we evaluate each one individually and try to take as humane approach as we possibly can, while balancing the fact that we have investors' money that we're responsible for protecting, and trying to work with tenants to the best that we possibly can without losing our shirt. So, a lot of retailers called us up and said, we can't pay rent for 90 days or 120 days or whatever it is. And if we allowed everyone to not pay rent, then we would have no money to pay the real estate taxes and pay the staff that works at these centers and sweep the parking lot and all the things that still need to happen, in addition to, let me not forget, paying the mortgage, none of which we received any relief from. So it's a balance. And what I tell the tenants I've spoken to is that it's all about collaboration to survive this together. And we've had a ton of success with that. And I think that coming out of this pandemic, the retailers that were weak going into it may not survive. So while no one could have expected or anticipated this pandemic to occur, I mean, none of us have ever seen this in our lifetime, the retailers that were on the edge, likely we factored in that they were not going to survive. Maybe they go out of business sooner than we think. And the ones that will survive should survive and be stronger coming out of this. There's a thing called sales transfer. So for instance, if you had a property with 3 department stores and 2 of them go away, there's going to be sales transfer to the one remaining. So in theory, that one remaining should do better. Their sales should go up. So there's a lot of different nuances of what happens coming out of this, where we think the retailers that are strong enough to survive will be in a much better position. And believe it or not, we've seen things start to stabilize, and we have actually signed quite a few new leases, which is I think the ultimate indicator that that entrepreneurs, because these new leases are predominantly being signed by local and regional retailers, that entrepreneurs are confident that the market is heading in the right direction. They're confident in their brick and mortar presence, and the fact that whether they're a service retailer or a apparel retailer that has much better margin by opening up a brick and mortar store, it's the ultimate affirmation that brick and mortar, the value proposition of brick and mortar is strong and here to stay. We've also seen a component of the strongest discount retailers continue to have open to buys and looking to expand. TJ Maxx is sort of the marquee tenant. They happen to be our largest retailer by rent, and we've seen them continue to grow in addition to other retailers like Dollar Tree, different discount retailers that leaves a lot of space in our portfolio. So we're optimistic, and our job is to solve problems and put out fires. And to the extent they come up, that's what we do and we will do. And fortunately, we know what we're doing, and we're very confident in our ability to backfill these spaces. And the uses might change. They very likely will change. We'll probably see more medical-oriented tenants. Believe it or not, there are still entertainment tenants, experiential tenants, still looking to grow, trampoline parks in particular. So it's not as bleak as one might think from reading the news every day. But there is stress, and we are working through it one lease at a time.
Well, that's good to hear. And I know kind of what you mentioned about there's being blood in the water, and of course, not to be insensitive, but Time Equities is a real estate operating company. We do have investors. Our goal is to maximize returns while being obviously as as understanding, as compassionate to the tenants as possible, since it is a symbiotic relationship there. But I guess my main question is, it seems like this is an opportunity if we are giving up our core right as a landlord, which is to collect rents. If we're going to give up our core right as a landlord, are we seeing opportunities to not exploit our tenants, but maybe renegotiate the leases to bring them more in our favor, extend the leases if we're going to give them any free rent or rent deferrals? How are we potentially going to come out of this, and other real estate owners going to come out of this hopefully better than we were before?
Yeah. The short answer is yes, we've done all that. If a retailer is withholding rent and we're pursuing defaulting the tenant, then everything's on the table. And we have taken the opportunity to provide, one of the ways we look at this is us providing, short-term support or financing or even an investment in the tenant's business. If we agree to carry a tenant's rent for 3 or 4 months, we look at that as us investing in them. And it shows the ultimate support for our own retailers. And in exchange for that, we expect something in return. And if we didn't, then we would go out of business ourselves. So everything's on the table, and that's why we read every single lease when these requests come in. And some of the modifications that we have been working through have been co-tenancy clauses, exclusive use provisions, increased duration, deferrals with paybacks, and everything in between. So we do feel that the value of our leases coming out of this will be more valuable for the ones that are remaining, so long as they're still in business.
Well, that's good to hear. Very good. And that's, I'm sure I expected that from you and your team. It is obviously difficult. We're all working from home for the most part. I know our office in Union Square in Manhattan has started to open up, but it's not the biggest office. So I know we will be trying to get back into that. Before I ask any more questions, Ami, I do have one more for you, and looks like you're a little bit
Jack, you there?
Yes. Sorry, my network just went out.
Okay.
You can hear me now, though?
I can hear you, yeah. Your screen's muffled, but I can hear you.
Oh, man. Well, my screen just totally went out. I'd like to take this opportunity to pass it back to everybody else for some questions. See if anybody has any questions. Please feel free to type it into the chat box. Not exactly sure what just happened here with my Wi-Fi. But if anybody has any questions, please do type them in the chat box. Ami, can you see that chat box?
Yeah. I can.
Okay.
Okay, here, yeah. Would you like me to read them or?
Sure, read them out and go for it. Yeah, if you can answer any of them.
Anticipated duration of reduced distributions. I'm going to pass that to Alex and Jack.
Sure. So that is, that is a situation we're obviously looking through currently. What Ami had mentioned earlier about our going in acquisitions, how we're able to buy them so well. Hopefully I'm back here in a moment. All right, here I am. Hi, everybody. So going into each one of these acquisitions, we were able to buy each retail property at such high returns that we have significant amount of cash reserves on each property to make sure we're getting through this current market downturn. Now, that said, given the lower rents on each one of these individual assets, we want to do everything we can to not dip into those reserves. Therefore, we do expect to have reduced distributions ongoing until we're really going to review this every day, week, and month. But we expect to say conservatively that these reduced distributions will likely go on until at least the end of 2020 and potentially till January 2021. at which point, of course, we'll always revisit this situation. The idea with our investors, Ami mentioned, we're playing a little bit of a balancing act between the needs of the properties and the needs of our investors, who obviously have become so accustomed to our stable, ongoing distributions that they've all been enjoying thoroughly. So right now, what we're doing is we're really making sure that each property and each fund has significant and sufficient cash reserves to get through what is still an uncertain future, while continuing to distribute some level of return to our investors in those deals. If you have any other further questions on that, please do feel free to reach out again. I'll give you some more details, but great question, and thank you for asking. Ami, I'm not quite able to see any other questions. Do you see any more?
Working from home impacted our team. So.
Oh, okay, yeah, that's one that I had. Yeah, certainly.
Yeah, right. So, my team spends the vast majority of their life, including myself, on an airplane, and that's our norm. We're constantly in the market, meeting with retailers, touring the properties, or at conferences, meeting with investment sales brokers, retailers, lenders, that sort of thing. And so it's been an abrupt change to not be on the road, but we were always set up to work remotely. So we didn't miss a beat. Everything that I do, I can do from my cell phone. So, we were always set up in that way, everyone on my team. And so we didn't miss a beat in terms of access to our files or leases or ability to negotiate or anything like that. And we've moved all of our leasing to a virtual capacity with our attorneys, and that works generally fine. And all our lease signing happens via scans, electronic signature. So that's sort of what's happened. The other thing that's interesting is that, one thing I've noticed is when you need the relationship with a retailer, a personal relationship, it's hard to go produce it. And, when you need it, you want to have it already. And so because we're working remotely and not able to go out and sit with the retailers in person while weeding through some of these requests, one thing I found is incredibly impactful is to have the relationships and leverage those relationships to be able to get to a deal quicker, or really call someone's bluff, or figure out really what the need is. So a lot of retailers have chosen to send out blanket letters saying we can't pay rent, or we need a reduction, or something to that effect. And luckily, we've been able to pick up the phone and call someone to parse out what's real and what's not real. And that's benefited us too. That has been a tremendous benefit to us.
Well, thank you for that. Ami, we're getting dangerously close to this 1:30 stop mark, so I do want to give everybody my contact information. For any of you who have not had a chance to reach out with any of your questions here, I'm going to type my email into the chat box at the moment, and you can please feel free to reach out at your convenience, and we'll be happy to answer any and all questions. For those of you who are not on video, you can hear me now. My direct email is jgoldberg, the letter J, Goldberg, Goldberg, at timeequities.com. And Ami's, if you want to reach out directly to Ami, is aziff at timeequities.com. So Ami, I want to thank you again very much for your time. I'm sure everybody here thanks you as well. I do see one more question, and Bill, I will reach out to you after the fact with some additional information if and when I do have that. But Ami, thanks again for your time. Good luck with everything. Keep up the good work. We all appreciate all of the work that you're doing, and our investors surely do as well. So keep it up, and I'll speak to you soon.
Okay. Thanks for having me.
All right. Thanks, Ami.
Okay.